Now we come to page 33, and people wax eloquent. Now, I hear all these screwy IRA schemes. And there's never one of them said, does this make having economic reality? Not one of them ever said, would this stand up anybody looking at it? They're all saying, I bet they'll never see this. And they're probably right. But one thing I have to recognize is that somewhere along the line, when you're too old to make it back, and they discover what you've been up to, the tax code, section 239A says, anytime you've done anything for tax purposes, and there's a sole benefit of tax purposes, we can disallow it. Say you didn't do it, so it's fully taxable. So you got all these great tax-free IRAs, Roth IRAs. And remember, you paid the taxes on the money before you could put it in. So that's not a deduction to you. So you're paying, depending on your tax bracket, you paid the $5,000 you put in plus whatever your tax rate would have been on that $5,000 to get it in there. And then you wheel and dealed it and all these screwy schemes. Now you got big bucks in your IRA, you're ready to roll. And they decide to make you a case. Or maybe they wake up one morning and say, hey, we got $3 trillion in IRA and we're broke, let's go steal the money. We'll change the rules. We'll audit every IRA out there. And we'll go back to day one, every investment they ever made, and every deal, we'll go under a microscope until we find a mistake. As soon as we find a mistake, under current tax law, we'll disallow the IRA back to day one. Then we'll recompute your taxes from day one. And what you should have paid, we'll attach federal tax liens to everything you own. We'll take everything you got away from your tax liquidation sales. You can be an old person sitting on the side of the road with your tin cup wondering what happened. And that's why I said, I don't think you should do those cute IRA schemes. They're just so cute. One day you're going to be too old to get the money back. It's foolish to bargain away your only hope for regular meals in your old age because you'll be cute today. But you don't have to be cute. You got to pay attention to tax code. I know a guy, he's 45 years old. Within 4 years of 1997, when they passed the current Roth IRA law, he had over $4 million in his IRA. All 100% legitimate. Run through the best accounting firms in the country and got blessed from 2 of them. So he does something real simple. You're not allowed to trade with yourself. Now you got to go and read IRS speak. What does that mean? Well, you're not allowed to trade with anybody that you control, any entity you control, or any relative or off-breed, or anybody who's a descendant of either yours or your spouse's grandparents, ancestors, they say. So you got to stay away from doing business with yourself. But he goes out. In first place, he forms trusts, Illinois Land Trust, and in those land trusts, they're going to be I said it wrong. They're not Illinois Land Trust, just trusts, and they're irrevocable trusts. And he names an independent trustee. And the IRA then buys all the shares of that trust. So the trust now owns all the IRA money he had stepped up to that point in his trust. Now his main job is as a developer. He builds 300 or 400 houses a year, big time developer. So then the trust is sitting there and say, where do we put our money? Where do we put their money? And they find this limited partnership. Gee, the trust could buy limited partnership shares now under limited partnership rules. A limited partnership by definition has no control whatsoever over the partnership. If they own 100% of the shares, they got no control of the partnership. But that would be one of these cute deals. He wants to build and continue to build, do things without any debt whatsoever. And I'm trying to explain this, how you do things without debt, big things without debt. So he used a limited partnership to round up legitimate money by who wants to get in on one of my development schemes. Now, remember, he's a successful developer, and everybody wants to get in his development schemes. So he raises enough money to build his developments through the limited partnership. One partner of which is his trust, which holds the IRA funds. Under partnership agreement, you can allocate profits any way you want to, any way that the partnership will put up with. So he allocates a whole chunk of that money back to the share that his Roth IRA owns. Now, every limited partnership's got to have a general partner. The general partner is a corporation. He owns 48% of the shares of the corporation, not control of it, 48% of the shares. And these legitimate investors, non-related parties, they just raise the money with the partnership, they own the rest of the stock. So they've got 52% of the corporation. He's got 48% of the corporation. But the joker in the deck, he's the only guy who knows what to do. So they can take over the corporation, but they don't know how to build projects. They don't know how to do stuff. They're just investors. So they have no inclination whatsoever to ever vote against him. So while he has no control of the corporation, if 3% of the rest of those people vote against with him, he's got control of the corporation, honey. But he doesn't have legal control. So that means he is not self-dealing. He's not doing anything himself. A company that he owns 48% of the shares of is directing a partnership that he only owns one little piece of it in a trust held by his Roth IRA. But now he makes a dollar. He makes a dollar. Here comes a dollar. At the corporate level, the same 52% of those shares are held by the same limited partners that came in the deal. So they basically can take money off at the corporate level for being stockholders if they want to declare a dividend. And right now, dividends are only taxed at 15%, and it might be a really good thing for them to do. But they get a choice every year how they do it. The part that flows through on down to the partnership as distributed to the shares goes right into his Roth IRA. So in 4 years, he got lucky enough to have all the right decisions and made $4 million. He doesn't work anymore. He owns timeshares all over the world, and he lives in timeshares all over the world. Doesn't have a house. Oh, yeah, I guess he does have a house. Doesn't go there very often. But he just lives in timeshares. We just came off a boat in Italy with him, and he crawled. He said, "Where are you going?" "I'm going back on another boat. We're going to ski diving off the Greek islands. We're going to do that for a while." And he just lives like that. He says, "I guess I ought to take an interest in making more money. What do I do with it?" Smart guy. Quit when he had enough, mid-40s. But that's using the tax code legitimately to build up assets legitimately that are audit-proof in a tax-free entity and not pay tax on it. Now, he can't use his Roth IRA money because he's not 59 and a half yet. You got to be at least 59 and a half and have held it for 5 years. He can't do that. But that wasn't the only money he had. So he had some more money too. Because remember, he still was in that corporation, and he can pull wages out of the corporation. He can name himself president of the corporation. He can pull fringe benefits out of that corporation. He can do anything he wants to at the corporate level to raise a little money and let the rest of it flow through tax-free. So he has enough money now to support himself floating around the world on those timeshares. And when he gets to be 59 and a half, he'll just quit. He'll resign from the corporation and let that money that's been compounding all this time in that Roth IRA be many, many millions of dollars. He'll live off that tax-free the rest of his life. Now, see, that's the plan. Mike said you had to have a plan. That's the reason you want to have plans. You want to say, how do I want it to come out? I don't want to plan for tomorrow. I don't want to plan for my next meal. How do I want it to come out? How do I want my old age to be? Do I want it to be my old age where Obama comes in, we're paying taxes through the nose? Or do I want to have an old age where I just laugh and laugh and laugh, say, mine's tax-free, pal, and get lost? You got to decide for yourself how you want it to come out. Everybody's a little different place. But you should really think about that. Give us some serious consideration of how much money you let go of now because you just don't want to get involved understanding anything about taxes. Heaven help you. Now, I don't want you to construe this to be any kind of a commercial for the tax course I'm giving next time. That'd be dirty pool. I would never do that. But it's just something. We take that tax-free money. I don't have a Roth IRA. You had to come under certain income limits, so I could never get under them, so I could never have a Roth IRA. But I did roll a qualified corporate pension plan into an IRA. So let's assume that you are a wheeler dealer, and let's assume you can't help yourself. You're going to make money no matter what, but you really don't want to pay taxes. So the first thing you want to do is you want to form a corporation, and let's assume, for sake of argument, you're around 50 years old, because that's when it really starts making money. The best thing about the qualified corporate pension plan is that old age is a blessing. The older you get, the better it gets. So when you're lamenting that first gray hair, think, yeah, but think of my corporate pension plan, I can really, really make big bucks now. So I had as a mentor probably the most preeminent CPA in the country of his time, named Charles Constantine from San Diego, who was the guy who got the Starker Amendment through the courts, and he's the guy that did much of the exchange legislation through the courts, and he was the man. And nobody would take him on. Iris was petrified of dealing with him. He never lost, and they wouldn't take him on. So he was my mentor, and he guided me into the corporate world of corporate pension plan. And I don't want you to confuse you with some bogus little slippery little corporation stuck out in the boonies in South Dakota somewhere because you're going to do something cute for the state of California. I'm talking about a business that makes money, not just a corporate shell run by three guys on a telephone in Palatka. You know, a real business, a real legitimate thing. You form a corporation in some state that has no corporate tax. There's a bunch of them. And it makes money. And the way it makes money is every time you make a house deal, depending on your recording cost, if there's low recording fees, you contribute a house to the corporation. If there's high recording fees, you contribute an option on that house to the corporation. And it's a contribution. So the corporation now owns the profit, either through the option or through the ownership of the property. And you're a wheeler dealer. This is you get in and out quick, but I don't want to pay any taxes. So the corporation then sells that, whatever it is, and corporations don't have capital gains. They don't have them. And as an offset, they can pay you a dividend tax like capital gains. They can do it up to 2 more years. So if you want to take money out, it can pay you a dividend, and you'll pay 15% maximum tax rate on a dividend. There's no alternate minimum tax on dividends. You'll pay that. Or you can just leave it in the corporation, and the corporation then can expense it. And the corporation can expense it by paying, for example, I had a corporation own 2 houses, and they made me live there. I mean, I had a job, I was the president of the corporation, so my contract, and I had a written contract, says that if you're going to work for this corporation, the corporation has no other place to live. You have to live in corporate quarters. It's the only building it owns. It'll do all administrative activities of the corporation will be from there. The tax forms will be filed from there. The mail will be sent there. It's where the corporation does business. You got to live on the premises. And if it's a condition of my employment to live there, they can pay me less money personally, but provide my housing, my utilities, my interior maintenance, my exterior maintenance, my food on corporate premises. They can provide me all sorts of things. It's a deduction of the corporation, not income to me. So it comes off their tax bill and does not go on my tax bill and pay me a very low salary. Now, having got that corporation up and running, now remember, I can always provide services the corporation and pay extra for them if I need a little extra money. Now, I take this house I bought at the foreclosure sale real cheap, and I make a contribution to the corporation. If it doesn't have any money and I do, I make a contribution of those houses to the corporation. When I make a contribution of those houses to the corporation, then for tax purposes, what I've got invested in that corporation goes up by the amount of the money I paid for the house. And the corporation's cost of the house is proportionate to my cost when I donated it to it. So now the corporation sells the house. Remember, I'm a wheeler dealer. Corporation sells the house, cash, gets cashed out, got the money. But now the money didn't come to me, it went to the corporation. When the money went to the corporation, it would be taxable to the corporation, which pays much lower tax rates than me, up to the first $100,000 or so of net income. Until it makes $100,000 or so of net income. Now, net income is what they measure after expenses. One of the big expenses is a qualified corporate pension plan. So if I put a house in, and let's say I made a $50,000 quick profit on a house, and the corporation is under its pension plan regulations, it's all set by the law, it takes that money and contributes it to the pension plan for my pension, for my retirement. It deducts that contribution, the $50,000. I'm not taxed on it till I withdraw the retirement. And I got 50 grand in a retirement plan now, pure profit that I would have been taxed on personally, but will not be taxed on in that pension plan until I take it out. I have to start taking it out at age 72 and a half. But I don't have to take it out then, and then that corporation pension plan, from that point on, can lend that money out to people just like me, but not to me. People just like me, and make big bucks. Everybody understand that? You understand why it's so beneficial? You understand how you can compound assets so fast that way? Now, every time you need a little money, sell the house and keep it. Pay the taxes. And you'll pay some taxes, and that's fine. But you need to eat, so eat it. Eat the house. But when you don't need the money to eat, you can pop it in that corporation, have it sell it, put it in this pension plan. Effectively, you're able to wheel and be tax-free. Absolutely legitimately. It's where the code's written. It's worth knowing, worth doing, worth getting involved. You got to open your eyes. See, you got to quit throwing money out the window as you drive down the street for taxes you need not pay. It's nothing slippery, nothing foxy, no overseas trust involved, just a straight tax law. Now, how do you apply that? Sooner or later, your corporation begins to look pretty positive, doesn't it? You can do a couple things. You can roll your money out of a qualified corporate pension plan tax-free into an IRA. Corporate pension plans are kind of expensive. You have bookkeeping, everything done on them, they're kind of expensive. You roll it in a self-directed IRA tax-free, as long as you don't touch the check, as long as it goes straight from your, now remember, I forgot to tell you, who's the trustee of your corporate pension plan? You are. There's no voting, there's no nothing. You control everything. So you take your pen out and you say, Jack Miller, comma, trustee. Now you're the pension plan. Jack Miller, just you. So you're the trustee of your pension plan. All pension plans are trusts, ultimately. And then you say, I want to form an IRA, and you walk that check down to end trustee, I want to open up an IRA, and now you got an IRA. Now once it's in an IRA, you can do one more thing. You can now roll over, it depends on your income, but you can, if your income's not too high, you can roll over the IRA funds into a Roth IRA. Now when you do that, that's the same as if you took the money out of your pension plan, they're going to tax you on it. But it might be worth your while if you're young enough and the money's, and you don't have to roll over too much money, maybe over $100,000, $150,000 into a Roth IRA. Now you've funded a Roth IRA not at $5,000 a year, but at $100,000, $150,000. And that sound better already? Now it's got some sea legs. They can go out and wheel and deal a little bit. Isn't that more efficient than to put on your $5,000 a year in your IRA and maybe you can buy a milk bottle top with it or something? You know, it's just an efficient way, a tax-efficient way of running your life. You're living tax-free in a nice big, now that's when you buy the big house. Well now, wait a minute, if the corporation buys the big house, how in the world am I going to avoid double taxation when the corporation sells the house? And how in the world am I going to get Section 121? Well, you know, they got a thing called a split purchase. That says if the corporation has a lot of money, you don't have very much, you can go up and buy a really expensive house. And as long as the corporation owns it for 10 years, it can revert to you at the end of that time. When it reverts to you, and there's a mathematical formula, how long, how much money you put up, and so forth and so on. But on a house that costs, suppose you're, I'm trying in my head how this would work. Suppose you're 50 years old, and you find a house worth $500,000. And you say to the corporation, you can have it for 15 years, I get it for the rest of the time. And you're reading the tax code, and the tax code says, well, all with wheels and wheels and wheels, you got to put up $100,000, the corporation put up $400,000. You got a corporation loaded with cash. So it buys this big old house as a corporate headquarters, and you move in. Now, the corporation doesn't rent it to you because you don't want to worry with rental loss or things like that. The corporation uses it in its trade or business, and it might be up in a place like Lake Tahoe, which is a nice place to live, and where you couldn't ever afford to go by yourself. And you live, and you get the Lake Tahoe lifestyle, and the corporation pays for it as a deduction. And after 15 years, the corporation no longer owns a house. It ran out of gas. It had an estate for term. It had a finite period of ownership that can't extend. Now the tax code said something else. Well, gee, it put up $400,000. It's only allowed to depreciate it at over 39 years. It's only depreciated about $100,000 out of the $400,000, and they've lost a house. What now? Well, the corporation takes the rest of the other $300,000 as a write-off that year. Now you put a whole wad of houses in the corporation, and they sell them. And with a $300,000 write-off against the houses, that's a tax-free sale. It writes off its losses against that house sale. So you time your windfall profits to coincide with that great big final write-off. The corporation now has a ton of cash, which is tax paid for tax purposes. It had a write-off to protect it. It's protected from the public. It's out of state, so it won't be taxed at your state level. And it just sits here, and it can do anything it wants to with that money. And you own the house that the corporation paid for. And if you set up 15-year financing, if you finance it, the corporation pays all the interest and everything like that. You got a free and clear house after 15 years, expensive, ready to roll, and you can either live there or sell it. Use 121. If the house has got more than $500,000 profit, you can go out and the year before the sale, declare this much of the house as an office and write it off. At the end, when you make the sale, you take the code says to do this, take the maximum amount you can under 121, and the rest you exchange for a qualified intermediary into other investment property. You still don't pay any taxes. So you don't have to do all this slippery foolishness to not pay taxes. Taxes are only involuntary for the person that doesn't want to take the time to learn the tax code. And how did I learn tax code? Went to school, read the books, paid through the nose for counseling, and paid attention to tax letters and saw what's happening. But it's the highest paid job. I started taking an interest in taxes when I was taxed at 50%. Taxes went up to 70% of my earnings, which meant or my income. If I made $1, the government took 70%. That's before state taxes, just took 70%. So I said, I get paid more for learning a tax code than I get paid for making money. Because if I can save that 70%, I keep the whole dollar. I was clear, I needed to spend my time learning taxes, not making money. I could keep more money, I didn't have to make near as much. And we may have that exact same situation coming up in the next 4 years. They've promised we will. Whether they get through Congress, I don't know. They've promised they're going to tax us through the eyeball. So it really pays you to really take an interest. Now, if you're not making money, ignore this whole segment. It doesn't apply. But if you want to think in terms of saving, if you're paying taxes and you're going to pay more, you just got to pay attention. And you can't hire that on the street. You can't afford the cost of doing that because the people know how to do this don't want to work for you. They want to work for corporate America. They want to work for the big bucks, $500,000 a year retainers. You can't hire that level of skill. You got to get it yourself. You got to learn it yourself. But it's just like everything else you ever learn in your life. Like taking geometry. You hated it, but you took it anyway. Take taxes. You hate it until the first year, and you see how much money you saved, then you get where you like it. You really, it's like a guy's got his hand in your pocket. You get to pull his hand back out again. It feels so good. Well, it depends on what he's in there for, but it feels good, so good. You find you go through the same thing. When you've got a great big profit in a house, and Pete brought this up earlier, and you sell it for cash, whether it's capital gains, whatever it is, you pay a tax immediately on that profit. If you've held it for at least a year, and how do we hold it for a year? By throwing something into the deal that you did hold for a year. So if you throw something, a scrap lot in the deal, or in my case I had timeshares, throw a timeshare in the deal with every deal. I had a richest guy in Canada. He owned Sun Life, controlling share stock in Sun Life. And he came down and he bought a house for me on a golf course. And I was doing an exchange. He had a house on a golf course, exchanged to me for an office building. And I said, I don't know why, I just took a liking to you. I'm going to throw in this timeshare. And you can go play golf on the beach. And if you don't like it, that's fine. Give us something. But I just want to give you one. So he said, well, thank you. So I threw in a timeshare. I had a $90 basis in the timeshare, 90. I bought it at an IRS sale. Now, from his book, he says, got a timeshare. Yeah, I made some profit. I'll throw it in the bin with the rest. From my books, I made an exchange. Exchanged one timeshare plus this office building, which I hadn't held long enough, for this house. And I still owned the house as long as I've owned a timeshare. See what happened? I took my holding period from that little timeshare over to that house. So I could sell the house, and I could exchange the house very shortly thereafter, which I exchanged for a waterfront property that Pete owned, very shortly after that. And I got the credit for owning that house for 15 years, as long as I held a timeshare. That's the tax code. So it gives you a chance to move very, very fast through opportunities, legitimately tax-free. So as long as you can keep moving up by exchanging what you got for what you want to have, as long as you don't need the money, then you move up, and that's really the way it's done. So I'm not going to talk anymore about taxes except incidentally in this class, but I just think I'm remiss to tell you, if you've found out how to make money, you do the things we tell you to do, and there's tremendous money to be made in the next few years, you're going to have a tremendous tax burden. It's going to be far, far worse at the end of 4 years than it is today. I think we've seen the end of these good years, and it'll pay you through the nose to really, really begin right now the process of learning what you can do and what you can't do. And for heaven's sakes, don't run it by some garden variety CPA. If you're going to run it by a real strategy by somebody, expect to pay $500 an hour, sit down and talk to them for an hour and pay the $500. Don't get cheap tax advice. There's no such thing. It might be cheaper what you pay, but it won't be cheap when they audit you. So if you're taking interest in taxes, and once you do that, get involved in your own tax returns, and find out why you're paying taxes, find out why you don't have to. You'll find out you'll have your $1,024,000 in the pike, not the $11,000. I'm done. Thank you.